Every day at exactly 5 p.m. Eastern, $2.4 trillion disappears from the American financial system. Gone. Not moved, not transferred, vanished. A Wall Street trader watches his terminal as the number drops from $2,400,000 to zero in minutes. This isn't a glitch. This is the Federal Reserve's reverse repo facility. And what it really represents should terrify every American. Because this isn't banking. This is controlled demolition of the monetary system in real time. And we're watching stage 3 of a 4-stage pattern that has collapsed every major financial empire in history. Picture the trading floor of JP Morgan Chase at 4:45 p.m. on any Tuesday. Traders aren't celebrating profits or analyzing markets. They're watching a countdown clock. 15 minutes until the reverse repo window opens. Billions of dollars waiting to flee into government safety the moment the bell rings. This is what financial panic looks like when it's institutionalized. When the world's most sophisticated investors have collectively decided that earning nothing is better than risking anything. Let me show you what's really happening. Every trading day, over 100 of America's largest financial institutions deposit trillions with the Federal Reserve overnight. They're not earning returns. They're paying for the privilege of parking money. That's not investing. That's panic. When the world's smartest money managers would rather earn 0.05% from the government than invest anywhere else, the system is screaming danger. Here's the pattern. Stage 1, abundance creates complacency. Credit flows freely. Everyone trusts the system works. For decades, money markets functioned as the foundation of American finance. Corporations, banks, pension funds all relied on overnight lending to manage daily operations, safe, boring, reliable. But here's what made it work. Competition. Hundreds of banks competed to lend overnight. Private market forces set rates based on actual risk. If Chase wanted your money, they had to offer better terms than Citi. If Citi wanted deposits, they had to outbid Goldman. This created real price discovery, real assessment of who deserved capital and who didn't. Stage 2, expansion beyond sustainable limits. After 2008, the Federal Reserve created tools to manage liquidity crises. The reverse repo facility was designed as an emergency backstop, a way to absorb excess cash when the system had too much liquidity. It was supposed to be temporary, emergency use only. But here's where it gets dark. Picture September 15th, 2008. Lehman Brothers collapses. Within hours, the Reserve Primary Fund breaks the buck. For the first time since the Great Depression, a money market fund loses value. $62 billion in assets become worth 97 cents per dollar. Panic. Investors rush to withdraw $300 billion from money market funds in 3 days. The entire short-term funding system nearly collapses, and the pattern repeated. Every crisis follows the same mechanism. Trust breaks, money flees, liquidity vanishes, credit freezes, the economy stops. This isn't the first time America has seen liquidity disappear overnight. August 1971, Nixon closes the gold window. Foreign banks panic and demand dollars instead of gold. The entire euro-dollar market seizes as institutions hoard cash. Or October 1987, Black Monday. Program trading triggers a 22% stock market crash in a single day. Overnight funding markets collapse, as no one knows who's solvent. The Federal Reserve floods the system with emergency liquidity to prevent total meltdown. But each intervention creates the need for bigger interventions. Each rescue makes the next crisis worse, because you cannot solve a trust problem with more money printing. So the Federal Reserve created the reverse repo facility, a place where money market funds could park cash safely overnight. Guaranteed returns. Government backing. No risk. Problem solved, or so they thought. But then something unprecedented happened. What was designed as an emergency tool became essential infrastructure. By 2021, daily usage wasn't millions or billions, it was trillions. Every single day. This is stage 3. Recognition that the system can't function without constant intervention. The reverse repo facility isn't managing excess liquidity anymore. It's replacing the entire overnight funding market. Private markets can't price risk. Trust has eroded so completely that institutions prefer 0.05% from the government over any private investment. Meet Sarah Chen, Chief Financial Officer of a $2 billion pension fund in Ohio. Every evening, she faces an impossible choice. Put overnight cash into private markets where overnight rates fluctuate and counterparty risk is real, or deposit it with the Federal Reserve at a guaranteed rate near zero. She's responsible for teachers' retirement money. She cannot afford to be wrong. So every night, like clockwork, $400 million flows from her fund into the reverse repo facility, not because it's profitable, because everything else feels like gambling with other people's futures. Silver represents millions of institutional decisions happening simultaneously, each rational, each logical, each contributing to a system-wide flight from productive investment into government promises. Here's the shock number that proves we're in crisis. In March 2020, reverse repo usage was essentially zero. By December 2021, peak daily usage hit $2.3 trillion. That means in less than 2 years, the Federal Reserve absorbed more than the entire GDP of most nations, every single day. To put this in perspective, $2.3 trillion is more than the combined GDP of India and Brazil. It's larger than the entire German economy, and it vanishes into government custody every single trading day because private markets have become too dangerous for institutional money. But here's the deeper horror. This mirrors exactly what happened during the 1997 Asian financial crisis. When Thailand's baht collapsed, institutions across Asia rushed to convert local currency into dollars. But there weren't enough dollars available through private markets. The IMF had to intervene with $40 billion in emergency lending. Not because Asia was broke, because trust in private currency exchange had evaporated. The pattern is always the same. Private markets work until they don't. Government steps in temporarily. Temporary becomes permanent. Permanent becomes the entire system. And it's not declining. Current usage fluctuates between $2.2 and $2.4 trillion daily. That's not emergency intervention, that's structural dependence. The American financial system literally cannot function without the Federal Reserve absorbing trillions in cash that has nowhere else safe to go. But here's what everyone misses. This money isn't just sitting there. Every dollar in the reverse repo facility represents a dollar that's not financing business expansion, home purchases, or economic growth. It's money fleeing productive investment, because managers can't find anything safer than government promises. Let me prove this pattern to you with history. November 1970, Penn Central Transportation Company defaults on $82 million in commercial paper. Suddenly, corporations can't roll over short-term debt. Credit markets freeze. The Federal Reserve intervenes, lends directly to banks, and creates the first modern liquidity backstop. Sound familiar? Every crisis follows identical mechanics. Private markets lose confidence. Government steps in. What starts as temporary support becomes permanent dependence. And here's the terrifying parallel. In 1929, call money rates spiked to 20% as institutions demanded immediate repayment of overnight loans. The stock market crashed because companies couldn't finance daily operations. Today, institutions are so desperate for safety they'll accept near-zero returns just to avoid risk. That's not stability, that's systematic fear. Watch what happens when you understand the real numbers. The Federal Reserve holds $8.5 trillion in total assets. Of that, roughly $2.4 trillion cycles through the reverse repo facility daily. That means nearly 30% of the Fed's entire balance sheet is being used just to absorb money that can't find safe private investment. But that was only the beginning. The system is now trapped in a feedback loop. Rising interest rates make private investments riskier. More money flows to the reverse repo facility. Less capital finances productive activity. Economic growth slows. The Federal Reserve must intervene more aggressively, which creates more distrust of private markets. This feedback loop accelerates with mathematical precision. Each intervention proves the system needs intervention. Each rescue validates the belief that without government backing, markets cannot function safely, so more institutions abandon private markets, which makes private markets more dangerous, which requires more intervention. Watch it happen in real time. September 2019, repo rates spiked to 10% overnight when a perfect storm of corporate tax payments and treasury settlements creates temporary dollar shortage. The Federal Reserve intervenes within hours, providing $75 billion in emergency lending. Problem solved, temporarily. But the message sent to markets was clear. Private funding cannot be trusted during stress. Since then, reverse repo usage has never returned to pre-2019 levels. Because once institutions learn that private markets can fail overnight, they never fully trust them again. This is what a liquidity trap looks like in real time. Not textbook theory, actual systemic paralysis where the safest investment is literally paying the government to hold your money overnight. And here's where stage 4 begins. Eventually, the Federal Reserve will face an impossible choice. Keep absorbing trillions daily, essentially becoming the entire overnight funding market. Or reduce the facility and watch private credit markets collapse when institutions have nowhere safe to park $2.4 trillion every single day. Picture what happens if they choose option 2. On a random Tuesday, the Federal Reserve announces they're capping reverse repo usage at $1 trillion. Immediately, $1.4 trillion has nowhere to go. Money market funds panic, managers dump assets to meet redemptions, corporate paper markets seize, banks stop lending overnight. Within hours, companies can't make payroll. Supply chains freeze. Credit cards stop working. ATMs run out of cash. Not because there's no money, but because the overnight funding system that moves $4 trillion daily has collapsed. But the reality would be even worse. Picture Walmart's Treasury Department at 3 p.m., trying to manage $50 billion in daily cash flows. Suppliers demand payment, stores deposit revenue, payroll systems need funding. Without access to overnight markets, the entire operation grinds to a halt. Not just Walmart. Every major corporation, every bank, every government agency that depends on short-term funding to bridge the gap between income and expenses. Now multiply that across the entire economy. Airlines can't buy fuel, hospitals can't pay staff, manufacturers can't purchase raw materials. The digital economy that processes $4 trillion in daily payments simply stops functioning, not because America is broke, but because the plumbing that moves money has been replaced by government intervention that cannot scale infinitely. This is how empires end. not with dramatic collapse, but with the gradual replacement of market mechanisms with government control until the government becomes responsible for functions it was never designed to handle. That's stage 4, the inevitable outcome when artificial intervention becomes so large it can't be removed without destroying the system it was designed to save. The Federal Reserve isn't managing a crisis anymore. It has become the crisis. Here's what smart money understands. This pattern has played out across centuries and civilizations. Ancient Rome created grain subsidies during shortages. Initially temporary, they became permanent. Eventually, free grain consumed the entire imperial budget. When Rome tried to end the subsidies, the population revolted. The empire collapsed under the weight of promises it couldn't keep. But there's a deeper parallel. In 235 AD, Rome faced constant barbarian invasions. The cost of maintaining legions consumed imperial revenues, so emperors began debasing the currency, reducing silver content from 90% to 5% over a century. Each debasement was supposed to be temporary, just enough to fund the current crisis, but each crisis required more debasement. Eventually, Roman money became worthless, trade collapsed, and the empire fragmented into competing territories. The mechanism is identical. Temporary intervention becomes permanent dependency, becomes system collapse, when the intervention becomes larger than the system it's designed to support. And the same fracture is forming again. The reverse repo facility represents $2.4 trillion in daily admissions that private markets can't function safely. Every transaction is evidence that the financial system requires government intervention to survive minute to minute. But governments aren't infinite. Central banks aren't all-powerful, and mathematical limits always assert themselves. The Federal Reserve can absorb $2.4 trillion daily for now, but what happens when it's $3 trillion, $4 trillion, $1 ? Imagine the Federal Reserve's balance sheet as a dam. In 2008, it held $900 billion in assets. Today, $8.5 trillion, the dam keeps getting higher to contain ever larger floods of money fleeing private markets. But dams have engineering limits. Eventually, the structure cannot withstand the pressure. When it fails, it doesn't leak gradually. It collapses catastrophically. And here's the mathematical inevitability. If money market funds continue growing at current rates, if institutional distrust of private markets continues accelerating, reverse repo usage could hit $5 trillion by 2027. At that point, the Federal Reserve would be managing more overnight funding than the entire U.S. banking system. Central planning would have replaced market mechanisms, not through ideology, but through institutional panic. At some point, the cure becomes worse than the disease. The intervention becomes larger than the economy it's supposed to support. And when that happens, the entire structure collapses under its own weight. We're not at that point yet. But every day at 5 p.m., we move closer. Every $1 trillion that vanishes into the reverse repo facility is another trillion, admitting the system doesn't work. An admission of systemic failure, repeated 2.4 trillion times daily, eventually becomes reality. Watch your screen right now. If it's 5 p.m. Eastern on a trading day, $2.4 trillion is disappearing from private markets as I speak, vanishing into government promises because the entire financial system has collectively decided that private investment is too dangerous. That's not a market. That's an economy on life support. If you want to understand how this ends, how the reverse repo crisis connects to bank failures, commercial real estate collapse, and the coming credit freeze that makes 2008 look minor, you need to watch the next video, because what I've shown you isn't the crisis, it's the symptom. The real disease runs much deeper, and it's accelerating faster than anyone realizes. The next video reveals the $23 trillion commercial real estate time bomb that's already exploding, why regional banks are hiding $650 billion in unrealized losses, and how the reverse repo crisis becomes the trigger for a credit collapse that reshapes America permanently. The dominoes are falling. The question isn't if, but how fast. Subscribe now, turn on notifications, because when stage 4 hits, there won't be time to understand what's happening. There will only be time to react to what you should have seen coming. And by then, the $2.4 trillion daily disappearance will look like the warning everyone ignored.